If you're investing in real estate for retirement income, you need to hear this. My guest today thinks real estate is the wrong tool for that job. And of course, I think real estate is one of the best. So stick around. This conversation could change how you plan for financial freedom. Hey there, I'm Chad Carson. You can also call me Coach Carson. And on this show, I teach you how to use real estate investing to achieve financial freedom so you can spend your time doing more of what matters. And I'm joined today by my friend Erion. He's a fellow real estate investor, a real estate broker, and he also blogs at investingarchitect.com. Let's get started. So Erion, it's not uncommon that you and I text back and forth, and normally we're talking about real estate retirement or building wealth with real estate. But you sent me a text recently that said, Chad, I got a contrarian take here. I think real estate's good for starting. I think real estate's good for building wealth, but I'm beginning to question whether real estate should be the actual retirement vehicle, the one you live off of in the end once you've already built your wealth. And I thought you were joking at first because normally you don't take that take, but you weren't joking. And I take all your ideas seriously and I always learn from talking to you. So I want you to unpack this for me, Erion. What's your take on this?
As the years pass and, I get a lot more white hairs, as you've probably seen through through my podcast appearances over the years. I started thinking about, I'm in that sort of transition between being, having built a real estate portfolio and now you're figuring out what's the best way to now move into that harvester phase. What's the optimal way to do that? And the more that I've been thinking about it recently, I keep stumbling on this idea that I believe that real estate is the best weapon for regular people like us to take small amounts of capital or small amounts of savings and multiply that and build that into something meaningful. So in other words, it's a powerful wealth building tool, but might not be the optimal, passive income creation tool. And that's sort of this idea that I texted you about. And that's what's kind of kept me up in the last few months.
And the other thing you texted me was there's this meme, and maybe we'll get this on the YouTube video if you're watching it, but it's basically a cartoon. I think one of the Disney cartoons, and the cartoon character says something and like 50 swords like surround him. Like, how dare you say that? So you've just said some blasphemy in the real estate world area, and that real estate isn't a good income producer for retirement. So you got to explain yourself there. What's got your mind itching on that topic?
So if I think about being in the harvester phase and I am retired, whatever that means, right? The first image that comes to my head is I'm in the north of Spain, San Sebastian, going to pincho bars and trying to choose like which one do I eat in this place or the other, right? So as I think about my retirement income to support that vision, right, or that idea, the thing that I want to optimize for is simplicity. Right. So I want to reduce hassle and I want the income to be as simple as possible. Right. And when I look at real estate, I feel like there's some issues with the reliability of income at the time when you're most vulnerable. Right. Meaning, so I'll give you an example. So with my personal portfolio, right, there's been years where, for 2 or 3 years in a row, the portfolio has produced X dollars per year in cash flow, right? And then there's been years when it's been 40% less than that because of various things. Like there's years when there's more vacancy. There's years when insurance costs skyrocket or, property tax authorities are very diligent at getting their share, right? And these are all things that aren't really in my control as an investor, right? So the idea that your income could fluctuate by 40% is something that's a little bit of a nuisance now that I'm kind of more of an active investor because I'm not relying on that income to live. But as I'm taking a bite of that pincho and drinking that wine, that would give me a little bit of a heartburn, right? If the only income that I'm relying on from real estate is subject to variability of 30 or 40% in a year, that brings a certain level of anxiety that I don't associate with, like, it doesn't fit with my vision of what that retirement looks like.
And would you say, like, when you, so it sounds like the kind of the eroding of the income from operating expenses is kind of a core of what we're talking about here. Is that maybe there's like this roller coaster of expenses that sometimes they're low, sometimes they're high, but maybe over the long run there's a trend line where they're, the rent, ideally rent would keep up with the operating expenses over the long run. We can maybe debate that a little bit, whether that's going to happen. Rent goes up by 3% or 2%, operating expenses on total go up by 2 or 3%. And if that's the case, your cash flow should have a spread that's the same over the long run. It gets bigger or it's the same. But what you're saying is like there's periods of time where the property taxes are reassessed and those go up by 50%, or the insurance, there's a hurricane in Houston and the insurance companies bail and now you got to pay twice the insurance. Is that sort of what we're talking about?
Well, that's part of it, right? But there's a little bit of a dangerous component to this idea of looking at averages, right? Because when you look at investment performance, you tend to look at it as an average over a long period of time. But when you look at like spending retirement income, you spend that in the short term, right? Mm-hmm. So meaning like even if your average income over time gets stabilized because you have some higher years and some lower years, that still doesn't make it good that in those lower years the income is as low as it got, right? And if that's all of the income that you're relying on, right, that's a concern, right? That's a like what's now a nuisance because it's like, hey, portfolio is not performing as it did in the previous years. It becomes a crisis. It's because now it's not, hey, portfolio is not performing. It's like, hey, the income's not enough to cover the lifestyle. But it's not just operating expenses, right? There's certain things. So currently, for example, when you look at markets like Austin, right, where there was oversupply of rentals, it's the curse of a good market, right? Where if the market's really, really good, everybody wants to invest there. All the builders show up, they put up product on the market, and they usually put too much product on the market. And the next thing you know, you have declining rents. So you have, for example, in Austin right now, rents are down 20, 25% in some cases, depending on where your property is. And that's something that really I, as an investor, cannot prevent, right? Like it's not in my control. And I feel like, you either have to build a portfolio where it can withstand that variability, meaning like you're building an income that's much higher than you normally need so that when it drops down because of these things, you're still within that tolerance, which in some cases will keep you in the builder phase longer than absolutely necessary. Or maybe there could be a different way. And this is what I'm struggling with.
Got it. All right. I got lots of questions. I think the place I want to start though is I think the natural question would be, all right, if not real estate income, if that's not ideal, if it's too choppy, which I have some pushback on that actually, because I want to give some examples that I've had for my own portfolio and some other people I know. But if not real estate, like what are the alternatives in the universe that we might be able to look at? So that we have something to compare this to. What are our other options?
Well, I've been doing some research with my trusted Chat GPT-5. And there's this like nagging question in my head, right? It's like, okay, if I'm just a normal guy and I'm trying to build wealth, right? Real estate seems like the natural place to go because if I've got $10,000, right, I can't really do much of a dent with that in the stock market or some of the more traditional investments. It would take way too long, right? But if I buy a property and house hack it, right, and use leverage that is 25 or 30 times what my because I'm controlling it with a small amount of down payment, right, that has a multiplicative effect that I can't really match with any other investments in a prudent way, right? But then I started thinking, okay, but there's a lot of wealthy people in the world, right? So how do they think of this idea of retirement income, right? Because they arguably, right, if you're wealthy and you've got capital and you can allocate it to whatever you want to allocate it to, then you've got all the choices, right? You could say, hey, I'm going to buy all the real estate and pay it off, or I'm going to put money in stocks, or I'm going to do it in insurance, or I'm going to do it in annuities, or what. Like the whole gamma of options is open to you, right? So I started doing some research in terms of like, how do, and again, this is like trying to put all wealthy people into a monolith, right? Like there's, not everybody does the same things, but generally, right? One of the things that I found in my research is that wealthy people kind of, put investing into two big buckets, right? You have operating wealth and then you have passive wealth. So in the operating wealth, you have more of, business income, and even like direct ownership of real estate falls into this more like operating or more active type of wealth. And it's got its own benefits in terms of, producing income, producing almost asymmetric returns, right? Like you're not getting paid by the hour. You're sort of, if you're making the right moves, you can create a lot of capital that then you could, deploy in other places. And then they have, the passive side, which is more paper assets. And that could be, stock market, it could be real estate through paper assets like REITs and things of that nature, and annuities and treasuries and, inflation protected, right? And generally speaking, right, when it comes to producing income, they tend to lean more on the passive or the paper side than they do on the real estate side and the active business side, right? So this kind of, and this might be confirming my biases and kind of where I'm going with this, but it seems to fit well with this idea of, real estate and business income to build, and then paper assets alongside real estate to create income in retirement.
So some kind of, for you, maybe the idea would be some kind of split. So you have this operating business, real estate chunk of your wealth, and then you have the paper wealth, which might be a mix of stock market investing. Like in my case, that'd be index funds, for
Index,
example.
yeah, 100%.
Some people are going to have other, bonds or other things as well, treasury protected, inflation protected treasury bonds, things like that. But there's a whole mix of different things you can have there. But what you're saying is have some sort of passive investment to offset, to kind of go along with your more active investments.
Right, because, and I mean, it's not going to be like a perfect hedge, because there's times when both real estate and stock market suffer, kind of at the same time. They don't always counterbalance each other. But I can see a situation where, if you're going through, if your real estate portfolio is going through a rough year because vacancies are higher, there's more supply on the market, so people are offering concessions, and you're having to follow suit, or you're having to compete against like new inventory. Like that's what's happening in Austin now, where you have an older property and the newer inventory is coming in at the same price with concession, and it's brand new, right?
Yeah.
So it's like, so how do you compete with that? And then you have the stock market, the paper assets, where if you're looking at the retirement income from the perspective of simplicity and reliability, right? You can't get any simpler than, hey, liquidate 3 or 4% of your portfolio a year when the market's, having a positive year or better. Like from a simplicity standpoint, I don't think anybody could argue that it's a lot easier to just, sell and deploy paper assets than it is to, even when real estate is properly managed and it's in a quality area, there's just a little bit more of an operational drag if you're truly retired. Like if you're active, and certainly you can build systems and you could optimize that to a point where it's, something you can deal with, right? But again, in my vision of, hey, I'm somewhere and I just don't, like, I don't want to, I've thought about business all these years, and I've thought about my investing all these years, so that now I can sit at this bar and talk to this stranger and eat good food, right? From a simplicity standpoint, I don't think there's any comparison between the two.
Yeah, I would agree with that. And I'll just confirm some of the problems for myself too. Like Austin, Texas is a really good example of an oversupply, where you had a hot market,
Mm-hmm.
and in Texas, you're able to keep building. Like, so we see some of the California markets where they were hot and you couldn't build. And so you still had supply, issues. There's rarely a huge oversupply issue like there is in
Correct.
Texas, where you can actually build. I'm having a similar thing in Clemson. Clemson is a very small market, but we have these big supply shocks of apartment buildings that come on the market. And also this year we have a combination of some of the housing market is just sort of weird, where people are not, they had the lock-in effect with low interest rates, and so people couldn't sell their houses, and they decided just to put it on the market as a rental property, and they were able to lower their rents because they had this low 5%, 4%, 3% interest rates. So there was sort of a perfect storm for us too. We're lower. We have houses that are typically full. We have 3 of them that are now, we're having to lower the rent by 20, 30% just to get them running. So I have the problem as well. I think that I'll give like kind of a rough pushback case on this, or maybe just an alternative. Like, first of all, I like having multiple assets. So if people watch my show very much, like I like not just depending on real estate. And I see this journey as like, you start in real estate, you build wealth with real estate, and then you diversify in the harvester phase. You get into different things. So for me, that looks like almost all my retirement account is in index funds and stock funds. And so that's sort of how I get to that place where I'm having, this chunk of my portfolio is that. The non-retirement account is mainly real estate. There's some other stuff too. But I like the idea in the harvester phase of not just trying to optimize for return, but optimizing for diversification, for, hey, maybe I can take money out of the stock market this year if real estate's down, or vice versa. But I even combine it with cash, having just a big chunk of cash sitting there, so that if I have 12 months of expenses, I'm not
Right.
having to draw from either one of those, right? Maybe I can just have a little bit of cash set aside. So I think I'm going to make the argument though, with a couple of examples of why I think real estate is still a really solid floor. And and I'll give you my properties for example. So I track every single month KPIs, like just key performance indicators of like, here's the total rent we collected, here's what we expected to collect, here's the operating expenses, here's our NOI, here's our cash flow, and here's how much cash we've accumulated the whole year. I do on an individual basis. So like I have those 3 or 4 properties right now that are empty. There are some ups and downs. I have some swings on repair expenses, that kind of thing. But I think I've gotten my portfolio to enough of a size, and maybe that's something to talk about. Like, I have enough of a size where when there's 1 or 2 properties that are not doing as well or have big expenses, they're kind of offset by some of the other properties which are doing pretty well. So there's sort of a diversification of income that has offset that to an extent. So for example, I have some properties vacant right now, but I have some properties that we've had tenants renew for the last 5 years, and just every year it keeps going and going and going. So I think there's a way to quantify some of that, and maybe we need to increase our vacancy assumptions. Maybe we need to like increase our operating expenses assumption. If we're going to live off of our income, we have to be just more conservative with our maintenance, our capex, our vacancy. And I compare it to like the metaphor of an ocean. The depth of the ocean is your cash flow. And if you had a big storm on the surface of the ocean, so this is like a oversupply thing, interest rates are changing, things like that. The surface of the ocean, because of that storm, is going to have 25, 30-foot waves. It's going to be pretty choppy. Things can change a lot. But if you have a mature portfolio where you pay off a lot of your debt, for example, where you have a diversification of properties, like the chop is just on the surface, and you can kind of offset that with the portfolio as a whole. And so what I look at on my KPIs is like the total cash flow has been pretty steady even through all of this. And it has its moments, but we actually pay the bills with the cash flow. And I think the main reason that's been a benefit, this is something you and I've talked about on our prior shows, is by paying off debt, it's sort of been like I've entered the bond market along with, I've sort of done what you're talking about. I think I own bonds essentially by paying off debt. I instead of me owing 6% interest to a bank, I have become that bank, and I've kind of entered the mortgage market by owning my own mortgages. And that gives me a lot of stability, because that kind of increases the depth of the cash flow, and that the chops of the cash. When I had a lot of leverage, that those chops of ups and downs impacted me in a big way. It really was a 40% swing. But when the debt's paid off, or you have a big spread between your kind of debt cost and your income, then it's maybe instead of a 20, 30, 40% reduction in cash flow, is more like a 5% or 10% perhaps. I don't know what your thoughts are on that, because I know you and I both like that idea of eventually, stabilizing your harvester portfolio, paying off debt. But that's worked pretty well for me. It's worked. My parents have done the same thing. So I haven't had that issue so far of having the cash flow be not dependable.
Yeah. And I guess it could be I think your point of the size of the portfolio is well taken, because to take your analogy to a different place, right? Like if your portfolio is small enough, then we're really talking more about like an above ground pool rather than rather than the
That
ocean.
ocean, yeah. Somebody just
So,
did a cannonball in the above ground pool, and it was a big
yeah,
dude, and they just
yeah,
splashed a lot, right?
right. But so maybe that's and I think there might also be some um, like market differences, right? I mean, in Texas, for example, like the cost of insurance has in some cases tripled across
Mm,
your portfolio, right? Just
mm,
it's not even a like a market related thing. It's more like, hey, if you're in this county, this is what it is because it's just us two guys now that are writing policies. So do you want to buy it from me or do you want to
right,
buy it from Jim, right? Like
right.
that's all there is. But definitely having the portfolio paid off, also helps quite a bit. But I think one of the things that I see investors kind of make a mistake with is that they confuse their cap rate for distributable yield or money that they can spend, right? And in some cases, what I see is like the cash flow, or at least part of the cash flow that the investors are getting from real estate, is almost like a cash advance on their future capital expenditures, right? Where it's
Mm,
like, hey, you haven't had any like roof replacements in the last 5 years, and
right.
then after 5 years you have a roof summer where like 4 or 5 of them need to be replaced at the same time, and it kind of wipes out, and that is the part where I'm like, I feel like having just the same way that you have your retirement accounts, having that option where you can say, hey, in the roof summer, this can come in and kind of level things out.
Yeah,
As well as, it doesn't even have to be just defensive, right? You can also have a situation where, if the stock market is doing really, really well in a particular year, instead of doing 3 or 4%, you can do 5 or 6% or 7%. So then you can use it as a tool to go from, to sort of fatten your fire,
yeah.
year, depending on how things are going.
Yeah, I think the thing I agree with Erion, I think this, I'm really glad you brought this up because I think some of us who love real estate get so infatuated with real estate that we try to, it's like a cure all, like the old, this medicine solves everything. Like, well,
Inertia.
yeah, it's like
Yeah.
this medicine is good for some things, but to me, and I think we're on the same page here. The ideal harvester portfolio is one that doesn't have all its eggs in one income basket, one cash flow basket, and I'm 100% there. Like, because even with me, like I'm in Clemson, South Carolina. I'm a one factory town. Like if something happened to Clemson, and the university stopped dropping enrollment, started they're like, hey, we've decided for whatever reason, this isn't likely, but we've decided that we're going to decrease enrollment, or we can't fill up the seats anymore, or whatever. That would be a travesty for if I had 100% of my cash flow depending on that. That's the equivalent of being in one city or one location, because real estate is very location dependent. So for me,
Right.
like an ideal harvester, you concentrate your bets early on to grow, because that's the way to simplify and grow. But eventually having like a 50-50 or a 30-30-70 or some kind of like allocation where you're not all real estate makes a ton of sense. And then even within real estate, I'm really trying to diversify my locations a little bit. And I think, there's some operational drag there. So to your point, like when I'm sitting in Spain and having to think about a property in Montana or somewhere else, that's like, that's kind of defeats the purpose of that a little bit. But one way I'm experimenting with that is having, being a passive investor with other people. So I'm investing as a limited partner, not in a syndication, but with
Right.
one person who I've hand chosen, and I'm a long-term partner with them, and I'm their money partner, and I'm getting cash flow from a different market that's maybe not in the same, it doesn't have the same impact as Clemson. And I'm also, one of my favorite ways to diversify is within real estate, being the equity holder, the owner, but also be the note holder. So I mentioned paying off debt, but I really like, loaning a little bit of money here and there, or selling some of my properties on owner financing, and
Hmm.
having a portion of the real estate portfolio be a note portfolio, be a mortgage portfolio. And especially when you create your own mortgages, I mean, that's some pretty steady cash flow. Like whether the taxes go up, the insurance goes up, if you have a good credit borrower, somebody who's going to pay you on time, or if you have a really secure financing, that's really stable income. Like it's a good way to, I think the one of the best complements within real estate is rental income plus note income, some portion, and then a third one would be alternative assets like stocks, other more traditional stuff.
Yeah, but what's interesting about that point, right, is that when you go from active ownership of real estate to these other options, you're sort of moving away from that operational wealth bucket more into the past. Like it's the way
True.
to turn
True.
to kind of have your cake and eat it too, right? Like I still, I'm still sticking with the girl that took me to the dance, right? But we're just going to do it a little bit differently so that, like being an LP, for example, is something that, and I don't know how involved you are with your like sort of main investor that's doing the work, but it's definitely, there's less of an operational drag than if you were the main person, quarterback in the deal.
Yeah, and you are giving up control. That's the weird part. For those of us who are in real estate, we probably got into it because we like control and we like influencing things. And to be an LP is to say, my hands are tied behind my back, and you're the captain, and I'm just along on the ride for this. And yes, you do have influence, and you do have conversations, but by contract, that person decides when you sell, how much you do. I mean, it's a different type of arrangement, which I think that's the mental shift that I've had to. I'm kind of excited about, actually. It's like there are benefits to owning and controlling your real estate. There are benefits to being passive and owning paper. But I think the core of this conversation, which I think you're bringing up, which I really hope people resonate with, is that you don't want to pigeonhole yourself. The thing that got you there isn't always the thing that's going to continue to get you there once you get to the harvester phase.
Yeah. Yeah. It's a different season in your life. And, I mean, obviously, real estate almost has this like treadmill component of its own. And it's a good treadmill, don't get me wrong, because it allows you to, defer capital gains taxes and so on. But it also kind of makes it so that you kind of have to play the game all the way to the end, with your real estate proceeds. Otherwise, at some point, you show up to the toll booth and you got to pay, right? All of the tolls that you haven't paid all the way up until that point. But so I was also thinking about this, like, okay, well, if you use real estate as a wealth building tool, let's say you grow your capital from very little to now you've got a portfolio that's worth $3-4 million, right? Well, what's the how do you then kind of diversify, right? Because I've had plenty of clients that have done the reverse, right, where they've built their paper assets first because they're W-2 employees, they're company match, 401k, what have you, and then their net worth is very heavy on the paper asset side, and they're like, oh, I'm not too comfortable with this, because it's the same idea as like the same way that real estate has the variability of income or the possible variability of income, stock markets have the variability of value, which is in some ways like scarier, especially while you're building your wealth. But they then say, okay, well, with the money that I'm able to not spend, right, or with the capital that I have available going forward, now I'm going to build my real estate portfolio so I have these two legs of the stool working at the same time. If you've built real estate like I have, if you built your real estate position first, you have to start to think, well, what's the way to kind of balance this out, right? Obviously, one of the ways is to divest from real estate and then move that money into stocks and paper assets, but nobody wants to do that, right? And pay the taxes that it's like it goes against every fiber of my body, right?
Yeah.
But I think that probably the better way would be, as you're in this building phase now, or sort of in the closing parts of the building phase, the capital that you have a choice, right? You could either put more capital and keep building your real estate portfolio, or take that capital and build your paper assets. So then now you could have a more diversified holdings overall. So it's not a matter of like the people that are coming with the swords, right? Like it's not a matter of like, oh, was investing in real estate a mistake? Absolutely not. Like that is the best thing that I could have ever done. But then the question is like, from this point forward, right? Does it make more sense to keep adding to your real estate portfolio, or does it make more sense to then kind of build this other arm of your balance sheet that could then bring some additional simplicity in terms of income creation in the future, can sort of balance out some of the fluctuations on the real estate side, that's what I'm wrestling with.
Yeah. And so what I'm hearing you say is like when you've gotten in the savings habit, and so maybe you're in the last 3, 4 years of your what you think might be your earning career before you start living off some of your investments, you have 50,000 a year, 100,000 a year you're saving, and maybe putting those savings, instead of buying a down payment on another property with that, instead of paying off debt on your portfolio, maybe what I do is I start investing that in my alternate, whatever I've chosen as my alternative investments, my paper investments, right?
Correct.
I put it into that. I think that's sort of a middle ground. That's actually what I'm doing lately as well. Like a lot of, yeah, I've bought definitely the stocks in my retirement account, but also just some other non-real estate investments. Just put money in there just to see, just to diversify a little bit. I also wonder, Erion, like something you and I have both talked a lot about though, is there's these certain tools or moves that harvesters make that are kind of unique to them. They include things like rental debt snowballs of, hey, for the last 5 years of my wealth building, I'm going to start switching from new down payments to just paying the debt off. I want to
Hmm.
compare that strategy, that tool, to investing in alternative assets. There's also this idea, which is sort of sacrilegious as well. It's gotten me a lot of swords, people pointing swords at me, is just selling some of your properties, paying taxes on them, paying the capital gains,
Hmm.
not doing a 1031, and then using that money traditionally to pay off debt on your existing portfolio. But that could also be, something you invest in the stock market. So maybe you've overbought in your portfolio. You have a net operating income of your whole portfolio that's above what you need to live off of. And so you sell some of the properties that are not your ideal properties, kind of prune off the bad ones, and then
Hmm.
you use that equity to buy stocks or buy something else with that. So maybe can you talk about those moves and how you still think about those with this other idea?
Yeah, I mean, I know that it's sacrilegious in real estate to talk about like selling and paying taxes, but I firmly believe that in the next 2 decades, right, people are going to look back at this time and say that was the time to sell and pay taxes, right? Because
Yeah.
I believe taxes are likely to be much, much higher in the future. And there's only so much that you can do with income taxes. And certainly they can go up from here, but there's a ceiling to how much you can raise them. So the natural candidate for increase is the sort of the benefit that some of the real estate investors get through capital gains taxes and so on. So I'm totally again, in an effort to optimize for simplicity, sort of selling some of the assets that are the biggest drag on your both performance and sort of the hassle factor that they bring with them every year. Because this is the hard part, right? Like when you look at your portfolio as a total, right? Like you could still, in other words, you could have like your good performers kind of carry the bad performers on their back, right? And you'd still end up with a decent outcome. But what you sometimes don't realize is that like sometimes a bad performer is like a double whammy, right? Like not only are they not producing income, but they're also eating some of the income that the other ones are producing. So selling one of those and kind of realizing some of the maybe the equity gains that have accumulated on those properties not only like frees up that capital so then you could put it in other places, but it also kind of removes that cannibalization of income that they the parasitic
Yeah.
effect that they have on the rest of your income.
It's an 80/20 rule of real estate. And I'm finding that so much right now. I know you do this analysis with a lot of your clients and yourself, but I'm doing the same thing where I'm going property by property and I'm looking at the historical cash flow. And I'm looking at a pro forma of what I think this property will do for the next 10 years. And I'm doing a internal rate of return. And it's amazing how 20% of your portfolio carries 80% of the cash flow. Like it works like that. And so to your point, like if you can study your portfolio, a big part of the optimization as a harvester is knowing when to prune and what to prune, and you can not lose anything. In fact, you could gain cash flow, and then even if you did pay taxes on some of that, I mean, you could do a 1031 exchange if that's what you want to do, and that's one way to do it. But then you could also sell the property and do something else with it and not lose any cash flow. Like you could actually be better off. And by so I'm a that's where my head is a lot right now is how do I allocate, shift around assets, shift around equity. And with real estate, it's not a fast thing to do. You got to plan this, you got to be strategic about it. But I think this is such an important conversation once you've built the wealth, to try to squeeze more out of that same portfolio, not only to get the maximize income, which I think is the first priority, but also to maximize peace of mind, maximize, this is your phrase that you coined, reduce your return on brain damage. I don't want to have this high return on brain damage with these properties. I want to increase cash flow, decrease my return on brain damage, and then also just have diversification so that I'm not so dependent on one location, one type of property. Like that's the order of the day for a harvester. But you got to think strategically about it. You got to look at the numbers and analyze it. Otherwise, you're just going off gut feels, which are not going to really get you the information you need.
Yeah, and I don't, I mean, you've got kids, and I'm just starting to feel like these phases of investing are kind of like the story with your kids, right? Where like, at least with my kids, I thought like when they were little, like that was the hard part, right? And then, and then they grew up into teenagers and like, oh, that was the easy part,
Yeah.
So I feel the same way with, it certainly feels hard when you're building because it's a little bit of a grind. It's like a diesel engine, right? It takes a little while to get fired up and it's slow in the beginning, but then once it gets going, it just goes on and it becomes easier with time. But sort of figuring out and threading the needle from this point into, creating income and harvesting and kind of letting, almost like weaning off of that like need for control that you said, or the need to like get wins out of your portfolio, and now moving into like, hey, now I'm going to try to optimize for simplicity and reliability and sort of like, I don't want to think about it type of quality about my portfolio. Like threading that needle is definitely more complicated and more nuanced, and it's very hard to do a one size fits all for that works for everybody.
Yeah. Well, thank you for introducing this conversation, Erion. This is going to be one of multiple conversations I hope we have on the topic. Also, I'm thinking about this a lot. So those of you who are listening, leave us comments if you are also working on optimizing your portfolio, thinking about asset balancing, where to invest, what to invest in. Would love to give your feedback. And Erion, I want to give you a chance to let people know about you, what you have going on. You're a busy guy. You have a real estate agency, property management. You have clients that you consult with, but let people know how they can get in touch with you and stay connected.
Yeah, so the best way to get in touch with me is at my website, investingarchitect.com. That's where I try to write weekly with new ideas and investing ideas like this, but that's the best place to find me.
So he's one of the ones I follow regularly. I like to always know what Erion's thinking about. So we'll have you back on later on, Erion. So thanks for your time and enjoyed it as always.
Thank you.
This episode, we talked about the idea of having alternative investments other than just real estate, but we didn't really get into the specific allocations, like how much do I have in real estate, what percentage in stock, what percentage in alternatives, like maybe even Bitcoin. So I want to recommend my next video, which is what I'm investing in now. It's a YouTube video where I break down exactly what my allocations look like right now. So if you're interested in that on YouTube, you can click on the thumbnail above me here, or if you're listening on the podcast or watching on YouTube, you can also click on the link in the podcast or the YouTube description below. Thank you so much for watching. I'll see you in the next episode.